going to start with you. The IMF recently put out its latest update to its World Economic Outlook, where despite the plunge in oil prices, you actually revised down your projections for global growth, citing other factors that had got worse than you expected 3 months ago. Why don't you set the stage for today by giving us the kind of up-to-the-minute view on where the world economy is heading?
So you're right. I mean, the big event is clearly the decline in the price of oil. And that's a very good event for, I think, the world, but surely for oil importers. I think there's one number which is useful to keep in mind, which is that if you have the average oil bill ratio to GDP, say 3 to 4%, a decline in the price is an increase in real income right away of 1.5 to 2%. It's a very large increase in real income. If it goes mostly to consumers, it's likely to have a big effect on spending. So that effect, I think, dominates. Then you can think of all kinds of effects which might weaken it or even go the other way. I think the net effect is definitely positive. So why is it that we did not revise the forecast up? It's because at the same time, there are other things happening which worry us on net a bit more than the good news on the price of oil. And there are two. First, there's a number of countries, mostly European countries, where the legacies of the crisis, the debt levels, not so much of the public sector, but of corporations in some countries, households in others, are still high and are clearly weighing on spending. So some bad news there. The adjustment is tougher than we expected. And then there's something fuzzier but bigger, which is a revision in the medium-term prospects, what we call a decrease in potential growth. And that's striking, especially in emerging market countries. I mean, the way in which we have revised forecast of potential growth for emerging markets is since the last 3 years is very substantial. Now, that's the future, but it affects the present, because if you know that growth is not going to be very high, then you invest less today, and so you have less growth today. So it was a very difficult forecasting exercise in terms of finding the bounds. With a lot of interactions with the desk, we concluded that on net, the bad news dominated a bit. I mean, there are differences across countries, not true for the US, for example. But at the time, I thought maybe we were too pessimistic on the net effect, on the positive effects of the price of oil by implication on the net effect. So I think if I were to, and I indicated it very politely at the time, saying there's upside risk that things will turn better. I think we're seeing some of its upside risk. I mean, I think for Europe in particular, because of all that, because of the depreciation of the euro, I think that our forecasts were probably a bit pessimistic.
So you're slightly less pessimistic you were rather when you did it?
I would go from slightly less pessimistic to maybe they should be a bit more optimistic.
Jason, the one...
I'm trying to follow that.
I think it means things are a bit better.
Okay, good.
The one country where the IMF massively upgraded its forecasts for 2015 was the US. And the US is doing extremely well. The last jobs figures were a blowout in many ways. The economy seems to be, if not firing on all cylinders, certainly firing on many more cylinders than it has been. Perhaps because I'm perennially worrying about things. It seems to me that we are perhaps in an area it reminds me of the late 1990s, when the US was also the engine of global growth, and when the rest of the world was not looking so great, when the emerging economies were in crisis. And I think it was Larry Summers who made a speech at that point that said the world economy cannot fly on one engine. Do you think the world economy is flying on one engine? And does it worry you when you look at what's happening to the dollar in particular?
Zanny, if you were anyone else, I would have said that was all really derivative of something you'd read in The Economist a month ago. But I suppose that would be an unfair thing to say to you.
I think we can all quote ourselves occasionally.
I've been known to do the same. I think the answer is yes, but. Yes, in the trivial sense that the IMF has what I assume is an integrated global model and not just you waking up figuring out what your mood is. And
it's both.
Slightly more optimistic or pessimistic. And in that globally integrated model, the last update was a substantial increase for the United States, a decrease for the rest of the world, and presumably their trade flows and everything added up in that model. One reason you can have a situation like that is 87% of our economy is domestic. We have substantial momentum in terms of consumers. We have potential in terms of investment. And a lot of those international headwinds are roughly offset by lower interest rates and a lower price of oil, as Olivier was talking about. So all of that leaves me with the best guess that we can. But the rest of the world presents, I think, a substantial risk. If you look at everything outside your standard trade flows macro linkage, there's a lot more negative things buried in there that could happen with contagion, psychology, earnings, financial system, everything else, than there are positive ones. So I think the rest of the world is a risk to us. It's one we should take out insurance against, both by engaging globally, strengthening our policies domestically. But my best guess is that we can keep flying in 2015.
In 2015. Stephen, because I know Jason won't answer this if I ask him directly, I'm going to ask you and then go through. The consequence of this, or let's posit we have this growth differential that continues. Mm-hmm. What does it mean for what the Federal Reserve does, and what does it mean for currencies? How much stronger will the dollar get? Will we reach parity with the euro, for instance? And then I can ask Jason what happens if that.
I travel to Europe and buy stuff. So
I should say that my own forecast, or HSBC's forecast, is not that it gets to parity. However, I think there is a significant risk that we could end up there, and from a policy-making point of view, one should take that risk fairly seriously. My view really is this, that there are lots of different parts of the world, central banks in different parts of the world, which are desperately trying to not just kickstart growth, but also to get rid of what they perceive to be worrying deflationary trends. And they are worrying deflationary trends. In the world of relatively high levels of debt, when you've got low growth, the possibility of outright deflation, those debt problems just get bigger and bigger over time. QE started off, I think, with lots of very good intentions, designed to cure really deep-seated problems back in 2008-09, a bit like a sort of powerful antibiotic designed to cure what could have been a sort of 1930s depression collapse. I think more recently, this is true, I think, both of Japan and the Eurozone, arguably, QE has become less of a powerful antibiotic and more of a kind of addictive painkiller. It's nice to be on, but doesn't really deal with the underlying problem. In Japan's case, what is striking about Japan is that despite massive QE, huge expansion of the central bank's balance sheet, a really massive decline in the yen, and it has been a huge decline relative to people's expectations, the growth consequences of this have been, frankly, very, very poor indeed. So if you look at the consensus forecast for Japan at the beginning of 2013 for 2014, so the forecast effectively a year ahead, the consensus said that growth would be about 1% in Japan. Then Abenomics comes along, everyone gets very optimistic, the forecast is revised up to 1.7. The latest consensus forecast for Japan for last year is only 0.3%. So that's lower than was the case before Abenomics ever got going. If you then say, well, what has been the consequence of this QE policy in Japan, I would argue the biggest consequence has been to effectively export Japan's deflation to other parts of Asia, which is why China, South Korea, and others are becoming more worried about the impact of a weaker yen. If you take that logic to the Eurozone, you might say that there are lots of benefits internally in the Eurozone, that QE will lift asset prices, encourage more in the way of capital spending, or whatever the domestic channels might be. But my guess is that if QE works primarily through the exchange rate, repeating some of the experiences that Japan may have had, there's a danger that all that Europe is doing is exporting its deflation across the Atlantic to the US. And I suppose it's possible that over the next year or so, notwithstanding the strength of the US economy in terms of real growth, one danger will be that US inflation drops further and further and further, and makes it more difficult for the Federal Reserve under those circumstances to justify raising interest rates. In one sense, you might say that's good news because it means that the US is being forced into keeping monetary policy looser for longer given global circumstances rather than local circumstances. But to the extent that the movements in currencies are merely a way of redistributing deflationary pressures from one part of the world to another, at the global level, the problem is still there.
Olivier, what do you make of that logic? Because that's a very interesting argument which suggests that basically QE in Europe and Japan is essentially designed to weaken the exchange rate and therefore is exporting deflation, and that this is all relying on the US, which may not then raise rates for longer than people anticipate. But is that the mechanism that you see, or do you see a different one?
Well, it's clear that there is not a whole lot of room for QE to affect interest rates. It does to some extent, but it's clear that it has led to, I think it explains a lot of the depreciation that we have seen in Japan. I think it explains a lot of the depreciation we're seeing in the Eurozone. I think there's, for us at the IMF, a question, which is it legal for countries to export their trouble this way? I think it was not intentional, and in the circumstances, they really don't have other tools. So, but in the end, what I would argue is a point that Stephen just made, which is that maybe this adjustment of exchange rates is a very good thing. It's helping the two places in the world which are in trouble, which need growth, which don't have the instruments to push it in the short run. And it's having an adverse effect on the US, but as Jason said, the US is doing well and seems to be able to take the blow. And so far, actually, the US has not complained very much about the stronger dollar. So it seems to me that adjustment of exchange rates, which comes largely from QE and expectations of more QE to come, is a good thing for the world.
Can I just add one thing on that, which is that I think one key issue here is does the US reprise its role as the kind of consumer of last resort, the role it was playing back in the 1990s and before the global financial crisis? Because think about global imbalances. Obviously, the US has got a much smaller current account deficit than it had. The Chinese current account surplus has come down a long way, as has the Japanese current account surplus. But there's still, I would argue, a global savings glut type problem. There's still a lack of willingness for countries to absorb those excess savings. Everyone's trying to deleverage, so you've got a series of what I'd argue are involuntary consumers of last resort. Countries have ended up with large current account deficits, didn't really want to have them. So you go from obviously Southern Europe, which had huge current account deficits, wasn't sustainable. Then you go to the emerging markets, where you have very big current account deficits in some countries like Brazil, for example, over the last few years, wasn't sustainable. And there's one country left, which is, in one sense, trying to be the consumer of last resort for the whole world. I'm very conscious of this because there's only your country and my country to a certain degree, which is the UK. We've got a current account deficit up at 6.5% of GDP, which bothers me because it is very, very large in the context of UK history and very, very large in the context of what's happened to other countries over the last few years. So I just wonder about where is the ultimate consumer of last resort, and could the US play that role over the next 2 years?
Jason, can I ask, can I pitch that to you? Yeah, and with one addition, which is the, I mean, you said, perhaps not quite as explicitly as I'm going to, but the US was okay with the dollar where it was. And that, but isn't the strengthening of the dollar likely to change the nature of the US recovery towards consumption and away from capital investment? And does that mean that it's going to, we are sort of in some sense seeing history repeat itself?
Right. The question is, are you building your economy on a bubble, something that's unsustainable? And you can look at that in terms of asset prices. You can look at that in terms of just underlying levels of indebtedness. The last two economic recoveries had a substantial portion of that, and we saw how both of those ended, one mildly, one much worse. If you look at where we are right now, consumers have worked off a huge amount of that debt, some of that in good ways, saving more, some of that in bad ways by not being able to get the mortgages that they probably should have gotten. But for whatever the reason, we now have debt service as a share of disposable personal income, the lowest it's been on record, and those data go back to 1980. That tells me we're not in an unsustainable position in terms of our consumers. When you aggregate it up, as Stephen said, we're not in an unsustainable position vis-a-vis our balance with the rest of the world. So I think there's more scope in the United States. There's not infinitely more scope. I think if your economic plan is to count on exports to the United States as your main or only source of growth, that's not an economic plan I'd recommend to any country. But if you're going to list the positives and negatives on the ledger, that you're doing business with the United States, I'm quite happy to have that on the positive side of any country's ledger.
Olivier.
Yeah, I want to go back to the consumer of last resort. I mean, if you think about the Eurozone or Japan, and what they want is more growth. And they would be perfectly happy to get it from domestic demand. but at this stage, it's very hard to get it, as we know. Again, kind of debt trouble for the firms, for the consumers. And so they're getting it from where they can get it, which is better exports, or at least the hope of better exports. I don't think the intent is to increase their current account surpluses. It may have this impact. But I think for the moment, what we need is more growth in these two parts of the world, and the way to get it is probably this way. Now, eventually, clearly, domestic demand has to pick up, and we have to have a more balanced recovery. But at the moment, I think that's what we have.
And I'd also say, I mean, there's two policy instruments for, sorry.
You go ahead.
There's monetary policy, which we've been talking a lot about, and there's fiscal policy. Fiscal policy has the benefit of being entirely about your domestic demand. It doesn't depend on the United States being what gets you out of your problems. It doesn't have some of the same effects on exchange rates. And there's substantial scope in a number of European countries to do more on fiscal policy. Japan took the very welcome step of delaying its VAT increase, which puts it in a less contractionary stance for its fiscal policy. And so that needs to be an important part of the conversation as well.
I remember talking to a German policymaker who shall remain nameless, but it was a few years back, and I asked him, what are the secrets of German economic success? And he said it was hard work, being competitive, having low inflation, and running a current account surplus. And I asked him, do you think that all countries in the world should follow the German model? And he said, absolutely. And then he realized that I sort of caught him out. That's we do trade with Jupiter or Mars or something like that. But going back to your point about the Eurozone, there is something odd about the fact that in the process of reductions in current account deficits in Southern Europe, which of course has been very, very aggressive and painful in many cases, there's been no offsetting reduction in the German current account surplus. It's just got bigger and bigger. So the Eurozone has, in one sense, reinvented itself as not so much the consumer of last resort, the saver of first resort.
Can I just, Olivier, ask you to, since the IMF's role is to look globally and to sort of assess what policies make sense globally, I mean, one way of simplifying and exaggerating, which is the business I'm in, what Jason and Stephen just said is that the US is the consumer of first resort in some sense because other countries are exporting their policy mistakes, that they are failing to act on the fiscal side, failing to act perhaps on the structural side, with the result that the only source of growth is net exports and reliance on the US.
I think that there is a misperception of fiscal policy in Europe, and the whole debate about fiscal austerity strikes me as a debate about the recent past, not today. I mean, as you know today, it's not that all countries are doing exactly what the IMF dreams they should do, but overall there is basically no fiscal consolidation in Europe at this point. Actually, you know, using the measures that we use, there's a small fiscal expansion in Germany. One might want more, but at least the sign is right. In general, I mean, these countries really have accumulated very large levels of debt. They feel that they don't have a whole lot of margin on fiscal, but they are no longer consolidating. And to first approximation, it's now fairly flat. Now, some people say that they should do more. One has to worry about the reaction of markets, and that's a debate which has happened over time. So it's not as if fiscal is completely off. They had to reestablish that sustainability. They have done it. I think now fiscal is neutral. But not, austerity doesn't strike me as the right word at this point.
Oh, and that wasn't a word I was using, and I think we have to be mindful of markets, but I think we also have to not invent a bogeyman that keeps not showing up. You look at Japan's decision to delay its VAT increase. There are people that would have warned that would result in a rise in Japanese interest rates. They've gone negative and fallen at the 10-year. You see in the United States, our interest rates below 2%, most of peripheral Europe the same. So that is an indication to me that markets see more space for either slower fiscal consolidation, fiscal expansion, but a shift in the stance relative to where it is now. And you combine that with a 12% unemployment rate in the Eurozone. When our unemployment rate hit about 5.5% in 2007, 2008, we felt we needed to do fiscal stimulus here. It's way past the point there.
Can I ask all of you, because I want to move on in a second to the consequences of this, but just the underlying the projections that we've made are some assumptions about what you think is going to happen to oil prices, what you think is going to happen to monetary policy, and even more deeper, what you think is going to happen to underlying productivity trends, because that affects expectations and hence real interest rates. Just let's get a sense of where you all are on that. I mean, and Olivier, maybe we start with you. Where do you expect oil prices to be in, let's say, 2 or 3 years' time? And where do you expect real interest rates to be?
So on oil prices, as one knows, it's dangerous to predict them, the same way as it is dangerous to predict exchange rates and stock prices. One can do a bit better than the random walk, but not much. The futures market suggests that there is a return. It goes up a bit, not at all back to 100, but maybe to 70. When you write down structural models and you think about who is going to come in the market or get out of the market, so you look at the effect on the marginal producers, and you make assumptions, geopolitical assumptions about the behavior of the Saudis and all, I think you get to the conclusion that the price will increase somewhat, but probably not back to 100. I think the factors which are behind the decline are factors which are, for the most part, going to remain. So I think on oil prices, we basically have been working with this assumption. Your second question is about monetary policy and interest rates.
Or real interest rates, actually, yeah.
So my sense is, I mean, look, in the US, we know interest rates will go up at some point. And for the Eurozone, my sense is because of the oil price, because of the exchange rate adjustments, we're probably going to see growth, not great growth, but growth, so that one can think of a time at which the ECB will start increasing interest rates. I'm not going to give you a date, but I think there's now a good chance that this happens one day.
One day, in my lifetime, maybe. Stephen, what about you? You rightly make the point that inflation has proved so much lower than people expected. Nominal growth has proved so much lower. Do you think, perhaps in contrary to Olivier, that actually we are at risk of slipping into sort of entrenched deflation, notwithstanding what the central banks are doing?
Yes, I think we are. If you look at the errors on inflation forecasts from, let's say, the consensus or indeed our own forecast or the IMFs forecast, there's been a persistent bias towards inflation returning to target, when in fact it actually hasn't done so. And it's been coming in lower and lower than expected long before the decline in oil prices. You can track this very, very clearly, that back in 2013, first half of 2014, inflation proved to be much, much lower than expected. Oil prices began to fall in the second half of last year. So obviously there's a benefit that comes through from low oil prices, but it's not the only reason why we have these deflationary pressures. I think forecasters tend to be rather lazy with regard to inflation. They take the view that central banks intend to hit the inflation target of, say, 2%, that the central bank has the technique or the ability to do so, and therefore will use that ability, and therefore the magic number will always be 2%. What worries me is almost like a reverse 1970s, that are we seeing a situation where for all the good intentions of central banks, actually the linkage between their monetary policies and the underlying performance of inflation is slowly beginning to break down. You know, there are various reasons for that. I mean, one of those effectively is the continuous process of deleveraging against a background of very high levels of debt. And another is, much less so in the US, but certainly in Europe, the sense that credit growth, whatever central banks do, is still extremely weak. There's a little chart you could look at which looks at Japanese money supply growth from the 1980s through to the first half of the 1990s. And what that chart shows is that there was a collapse in money supply growth at the beginning of the 1990s. It never, ever recovered. It remained extremely weak thereafter. At zero rates, at QE, whatever happened, it was still extremely weak. You draw the same chart for the Eurozone and the UK from 2000 through to 2014. It is almost identical. So to the extent that you've seen this collapse in credit growth and no obvious ability of central banks to restore credit growth to something that's a little bit faster, then it bothers me that that might be a lead indicator of more disinflationary pressures.
Jason, let's just posit for a second that maybe they're right, and that even though the US is now growing somewhat strongly, the rest of the world is not looking so great, and we're in an era of relatively low nominal GDP growth. In contrast to the 1990s, because I did start off with the 1990s, now this is happening against a backdrop of almost 2 decades, or 15 years, of stagnant median income. That's a very different environment than it was in the late 1990s. What are the policy consequences of that? Because our theme today was, you know, balancing growth and government. I think we've seen already a very vibrant discussion about what the role of government is. The president, your president, has laid out a whole series of policy proposals, and I don't want you just to recap them, but what is the sort of priority for government in a world where growth is sort of relatively modest, and we've had median wages being stagnant for really quite a long time?
Right. Yeah, I mean, you asked Olivier 3 questions before: the oil price, the interest rate, the productivity. You know, the first 2 are of a little bit of interest. The third one is the one I really want to know the answer to. Because if you look at what's happened to family incomes and that stagnant income growth in the last couple decades, that's due to 3 things. It's due to a slowdown in productivity growth. It was growing at 2.8% in the decades leading up to 1973. Productivity has grown at 1.8% since 1983. In this cycle, it's grown even a little bit lower than that. So without getting that productivity growth up, we can't solve that middle-class income problem. The second is inequality. That was steady through 1973, has skyrocketed since then. And for a while, we papered over the lower productivity and increase in inequality with a surge of women into the labor force and more 2 incomes in a family making up for it instead of just 1. Well, that's come to an end too. It's plateaued and started to drift down. So those 3 factors, productivity growth, inequality, and participation, I think are the 3 key levers for economic policy. And there's a whole range of things you can do. You know, business tax reform, infrastructure, trade on the first one, minimum wage, progressive taxes on inequality, family-friendly workplaces and tax reform on participation. But those are the 3 levers that we need to be working on. And you know, there are ones that aren't about what happens in 2015, which I'm quite optimistic and positive about. As I said, these are problems we've had for decades, and you know, could be much more daunting.
That's a very good point. And productivity, before I'm going to open for questions in a second, the issue of how to boost productivity. At the one hand, we are living in this, you know, what by all accounts is the most rapid period of technological change, certainly for the last 100 years, and yet the productivity figures are appalling. Is it just a case of, you know, it'll show up at some point, we're mismeasuring productivity, or is it that notwithstanding this apparent pace of change, our productivity really is growing more slowly? And if so, what do we do about it? Olivier.
I second your question, which is, when I wake up in the morning, I don't do the forecast, as you said at the beginning, but I wonder about the discrepancy between our perceptions of what's happening in the world and the productivity numbers. And, you know, we keep asking, how do you compute productivity? And it's clearly becoming harder and harder given the nature of technological progress. But yes, I have this suspicion that maybe the productivity numbers for advanced economies are understated. I think that's a very big issue, which would imply that if quantities are increasing more, prices are increasing less, which would lead Stephen to worry more about deflation.
More about deflation, but probably it would be a better outcome to have. Let's open up to questions. Do put your hands up. Yeah, gentleman at the back there, second row.
It's the first discussion of the global economy I've heard in a very long time in which no one said China. So I will, and ask if anybody wants to make a comment about the outlook in China.
That's a very good point. We should have mentioned it earlier. Let's start with Olivier.
So on China, we basically revised growth from 7% to 6.8%, and we thought that was very good news. And the Chinese government agreed. I think what's happening is that our assessment is that the housing boom bust and the problems of shadow banking are being resolved. We're much less worried about a catastrophic scenario than some were a few years back. But this is slowing the Chinese economy. In normal times, the Chinese government would have used infrastructure investment, other measures, credit, relaxation, to increase growth back to some high number. They have decided not to do it. The decrease in the price of oil makes it easier for them to do so, to basically have more of a hands-off policy. But we're fairly confident about the type of number we've given with relatively little downside risk.
Stephen, do you equally sanguine about China?
Well, our numbers are rather similar to yours, actually, which means we're probably both wrong. Well, I hope we're both right. I guess that I have a worry about the nature of Chinese growth and how it shifted over the last few years. And I agree with you that by accepting a lower growth rate is good news rather than trying to maximize growth all the time. If you go back to the pre-financial crisis world, China was very much an export-led economy. That story had to change because export growth collapsed relative to the experiences of the pre-financial crisis world. Then it shifts to effectively an infrastructure investment story, which is partly associated with big increases in debt. But the numbers that we have suggest that the marginal returns on capital in those areas in particular have fallen dramatically, possibly even negative in some cases. So there's some kind of capital misallocation problem there, which is in danger of getting bigger. And I suppose the big question ultimately is to what extent can China quickly move towards a world whereby it is more reliant on household consumer spending, and that depends on trying to create a proper credit system domestically that's priced appropriately. I'd love it to happen now, but I think it's going to take a long time for it to happen. So I think there's a kind of an interregnum, a period in the short term where I think things will still look a little bit shaky.
Next question. Yes, gentlemen, four rows back.
So we've talked a lot about the benefits of cheap oil, but what about the flip side, especially for the smaller, for the smaller EM countries that are exporters? And if there was a default of, say, Venezuela or even a smaller event that would disrupt them, would there be a chance of contagion to the rest of EM, even the importing nations?
Olivier, why don't you start with that?
I would admit that it's not such good news for oil exporters. This being said, many of them have accumulated financial resources which they can use at least for some time, and I think that they'll survive the adjustment. It's clear that there's a number of countries which are going to be in trouble. Venezuela is clearly one. Nigeria is also one. And the main one is Russia. Russia was doing poorly before the invasion of Crimea. It did worse as a result, and the result of the sanctions, and the decrease in the price of oil is even more of a blow than any of the two previous ones. So it's clear that there are very serious issues in Russia. The question was, is it systemic? Is it going to have major effects on the rest of the world? The assessment is no, that basically Russia will do poorly, but the rest of the world will be able to adjust to it.
Stephen, are you that sanguine?
I'm a little more uneasy, as you might have expected from my comments so far. The main reason, actually, is that the insurance policy that's existed in previous occasions when commodity prices have fallen isn't there quite so obviously. That insurance policy is lower Fed rates. You go back to the mid-1980s, when there was disruption associated with lower oil prices in certain parts of the world, other financial effects that came through, the US was able to cut interest rates. The same was true during the next major commodity price collapse, which was really during the Asian crisis, 97, 98. The US was able to cut interest rates. This time around, that insurance doesn't exist. Yes, they could go back to QE, other countries could do QE, but I wonder whether QE has quite the same effect that interest rate cuts have. So I think there is some issue there in terms of how do you deal with contagion if and when it were to happen. And I think the room we have for maneuver is lower than was the case in the past.
Jason, can I just ask you how much time you and your colleagues spend worrying about that kind of thing? I mean, back in the late 1990s, there was a lot of time spent in Washington worrying about where the next emerging market crisis would be. Is it something that you are concerned about now, or do you basically agree with Olivier that there's not much systemic risk?
It's something we certainly pay attention to and take seriously, but I think the bigger worries globally are a little bit less the tail events and a little bit more the slowing of China and its need to make structural adjustments, the slow growth in Europe, things that we're almost certain are going to happen over the next year rather than some type of spectacular meltdown, although we're always on the alert for that as well.
Next question. Yep, over there.
Yes, good morning. I have a question regarding Greece. On the one hand, what kind of compromise do you think should be reached between the current government of Syriza and the creditors of Greece? And on the other hand, what do you think actually will happen? And this question is directed especially to Mr. Blanchard. Thank you.
Well, I have something terribly unfortunate to tell you, which is that prior to coming on, Olivier said to me, I'm not going to answer anything on Greece. And Jason said, I'm not going to answer anything about the Fed. So I said, well, that's fine. Jason can answer the ones on Greece, and Olivier can answer the ones about the Fed. So you will not get anything very interesting from Mr. Blanchard, so I'm going to turn it to the other two. Stephen, what do you think?
this is an open sore that's been there for many years. In fact, it goes back to 1944 and the Keynes plan, which was the attempt to try to have a Bretton Woods system whereby the creditor nations, the ones with current account surpluses, had to adjust as much as the debtor nations. That has never happened, and the Eurozone is like a microcosm of that story. I find it very difficult to work out how there can be a solution that is face-saving for everybody with regard to what's happening in the Eurozone currently. The position of Syriza on the one hand and the Troika on the other, to my mind, and you probably can't correct me one way or the other, but to my mind, is so far apart that I find it difficult to see how it can be easily resolved without someone ending up being hugely embarrassed, either the Greek government or instead the Troika, and the Troika facing a situation whereby if it effectively relaxes its principles in front of Greece, then there may be other countries that will also come along and say, well, if you can do it for Greece, you can do it for us, and therefore things become increasingly unstable. Having said that, what also bothers me is that if Greece can elect a government that effectively wants to renege on all of the previous arrangements and gets away with it, or somehow, or is forced out of the euro, there's one obvious political danger in the Eurozone currently, which is the possibility that what is happening in Greece politically spreads to other countries. And loosely, you could say, that in Southern Europe you have the growth of support for left-wing anti-austerity parties, and in Northern Europe you have the growth of right-wing nationalist don't bail out anybody parties. And the more that happens, the more difficult it is to find any agreement that will actually safeguard the euro's future.
Gosh, that's rather sobering. Jason, what do you think there'll be a compromise, and what will it look like?
I was going to, if I got the question of Greece, point out that this is something Greece is working out with its creditors, and
or not
suggest that one of their creditors should answer the question. But I guess that's not going to work out very well in this panel.
I think the creditor is going to flatly refuse to answer the question. So I will save him that embarrassment and go on to the next one. Yes, gentleman there.
Thank you. Jason, you mentioned income inequality as one of the issues that you're focused on. What remedies are you contemplating to address that?
I think there's two different dimensions we need to think of the problem on. One is the time horizon, the short run versus the long run. And the other dimension is, are you doing something on pre-tax income, market income, or post-tax income? And I think we need to operate on both of those dimensions simultaneously. So a step like the minimum wage affects your market income, and it does it right away. A step like investing in preschool is also about your market income, but it's going to take 15, 20, 25 years before that student grows up and enters the workplace. Same thing, those are both market, and then we have to look at steps like more progressive taxation, the Affordable Care Act. You look at what the president's already done in that regard, and it's undone more than a decade's worth of increase in inequality, both through more progressive taxes and the Affordable Care Act. We can build on that at the upper end by cutting tax benefits for high-income households, including those associated with capital gains at death, and just a broad swath, mortgage, health, range of others. And then we can use some of that money to have tax cuts for college, child care, and secondary earners, all of which have this ancillary benefit of potentially increasing market incomes as well, insofar as they lead to more participation in the labor force and more pursuit of education.
Did these policies help to reduce income and wealth inequality, or do they slow the pace of the increase in inequality?
You know, I don't know what the pace of increase in inequality is going to be. Someone wrote a book predicting it out for the next 200
Indeed,
years.
yes.
That was a little bit bolder than I would be
on the basis of the last 200 years.
And
yeah.
that's why nothing I write will ever sell close to that. But we would have less inequality if we did all of that, and perhaps more importantly, we'd have middle-class incomes growing at a faster rate and less poverty.
Olivier, what's your view of this agenda, which is clear? Jason has summarized the president's agenda rather quickly. What's you and the IMF's view of it? Is it the appropriate one?
I think if you look across countries, what's striking is how much differences in inequality there is in market income, pre-tax, pre-transfer, and how some countries are able to reduce the inequality with various programs in place, maybe sometimes at the cost of growth, although we don't find much adverse effect. So I think that there is a number of tools which can be used, probably not to decrease inequality enough to the degree that we would love, but to do something substantial.
And we did appreciate that, and I think it tells us something. If the IMF is telling us to raise the minimum wage, the OECD has told us to raise the minimum wage. So some policies that 20 years ago had greater controversy associated with them have become increasingly mainstream.
One more question. Gentleman at the very back there.
For Mr. Furman, how much, on the immigration reform, one aspect that we haven't seen on workforce is the increasing availability of not just the H-1B visas, but also on the converting student visas to work visas. That was not so much part of the executive immigration action so far. And what can you do without a consensus with Congress on this, and what do you plan to do?
We tried to do everything we could do without a consensus from Congress, and we acted both on the enforcement side, on the people that are already in the United States, and on the high-skilled side. Those are the three different components that we're addressing in immigration. We, at the Council of Economic Advisors, estimated that that would add 0.4 to 0.9% to US GDP after a decade. Part of that is the extra labor force, but a lot of that was the extra total factor productivity associated with that immigration. Both of those estimates, though, are just a fraction of the added growth that the Congressional Budget Office estimated we would get using similar methods if we passed immigration reform. And it's really only by passing it that we're able to both substantially increase that skilled workforce and bring a lot of the ideas and innovation together with that.
I wanted, just before we close, to ask all three of you one question so that when we invite you back next time we can test to see what happened to your predictions, which is, which part of the world will surprise you on the upside this year, and which part of the world are you most worried about, or should the audience be most worried about? Very briefly, because we've run out of time and I'll get into trouble. Olivier.
I'm an optimistic guy, so it's difficult to surprise me on the upside.
You've just revised down your growth forecast.
But I'm more optimistic about the Eurozone making it than I think current beliefs are. It's going to be slow, but I think it's going to happen. So I think in that sense, that's probably an optimistic statement.
Okay. Thank you. Stephen?
I'm going to pick the Eurozone as my pessimistic story. So Eurozone pessimistic. Actually, I'm also quite worried about Latin America. I think that's worrisome. And just to be nice to Jason, I would be hopeful that the US might surprise significantly on the upside.
Gosh.
Can I disagree with Stephen on Latin America? I mean, one of the untold stories of the last few years is how they have revised their potential growth rates down, and how much, in retrospect, the first half of the 2000s was probably due to high commodity prices, and how they have to adjust to it, and it's turning out to be more difficult.
Oh, I think we're agreeing.
No, you agree then? It was more pessimistic.
Sorry.
Okay.
No, I was pessimistic about Latin America.
Sorry.
Yep, you're both, okay. Jason?
And two basic rules for administration officials on panels: don't comment on monetary policy, and the United States will surprise on the upside.